Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. This is Quincy Krosby. It is Monday, November 20th, and this is The Talking Point. Thanks so much for joining me. This is a shortened week, as everyone knows, but it is an important week for the markets. First of all, let's just go over the path of the markets last week. We are actually in short-term overbought conditions for the S&P 500. Now, what does that mean in real life? It means that normally what you see is the market kind of slowing down, not that really strong surge that we saw off of the market bottom. Now what you're seeing is the market continuing to climb higher, but at a slower pace. But typically, when you have short-term overbought conditions, something comes along that actually, has the market pull back a bit more. Not some gigantic sell-off, something that's dire, but where the market kind of burns off and consolidates the gains. We could say that, in fact, that is what the market has been doing, because the market certainly hasn't surged higher, and it has, seen a couple of sessions where the market was kind of quiet, moving sideways. That is another way that the market can consolidate or assimilate some of those gains, which is healthy, by the way. Even if we saw a bit of a sell-off, it's healthy. Markets need to, again, consolidate, take a breather, take a pause, however you want to characterize it. So we're going to pay attention this week to see, how the market handles some of the data and the consumer and how the consumer is spending this week. But let me also point out that in terms of last week, one of the things that was interesting about the market is that the market did not have a dramatic sell-off after we heard from Walmart. And I want to go back to that because Walmart's numbers weren't terrible. It was the guidance where the CFO and the CEO made comments about, what they are seeing. The CEO made a comment that, we may see some deflationary pockets in the economy looking ahead. And the CFO made a comment about the concern about consumer spending, and that they noticed that from October until the call was last week in November, they saw a drop in consumer spending. Now, this is important because Walmart, as you know, is one of the, if not the largest consumer-related stock that we look at. When they talk about the consumer, we pay attention. Now, many things are important here because you could extrapolate from those comments. And, the market was talking about this all week, that perhaps the consumer is slowing down and that it is going to intensify. That's where this is important. Now, the other part of the story is that the UAW strike ended. And we know that consumer spending was slowed because consumers involved in the UAW strike, the families involved, didn't expect to see that strike continue as long as it did. And the spending in some of the areas where the strike was more prevalent actually saw slowdown in spending. So we're going to see if there were special situations involved in that slowdown that Walmart pointed out. Now, the other part of the story is the labor market, and we need to see whether or not that pickup in initial unemployment claims, continuing claims, pulls back as the effect of the strike begins to unwind. Again, this is an unknown, but the point is it's important for the market, and that's what we're talking about, is how is the market reacting to all of this. Now, this is the fascinating part about the whole market move, because what we know from this recovery in the market, this rally in the market off of the lows, is that the view is that the Fed is finished and there's a dovish pivot. remember that word pivot? That is that the Fed basically declares victory and it is over and it's dovish. This is key to this particular part of the rally because the view is not only is the Fed finished, but that there are going to be rate cuts early on. That package of the Fed finished, coupled with that the Fed is going to start cutting rates sooner than the market thought, and perhaps even this summer, especially as the Fed has over and over and over again talked about that they are going to keep rates higher for longer. And even a comment that, we're not looking at rate cuts for next year. That's not what the market is saying. And therefore, the market is saying, no, we think that the slowdown in 2024 early is going to be significant and that the Fed is going to have to cut rates quickly. This is an interesting debate that's ongoing, but it is helping to underpin the market, coupled with, and this I can't stress enough, that the Treasury auctions. Remember, the Treasury Department on November 1st helped ignite this rally by suggesting that they did not need to have an oversupply in the auctions, that the supply was going to be lower. And overall, I just say this overall, that there would be more of the short duration notes going into market, because we saw what happened with the 30-year. That was not a successful auction. The interest rate was higher than the market had anticipated. In any case, this is the underpinning for the market, and rates are coming down. There's no doubt about it. But now I go to the next part. Are rates coming down because of a growth scare? Right? This is, again, part of the scenario that the growth and economic growth is slowing at a faster clip, and that the Fed, despite what they're saying over and over again, that they will be forced to cut rates as early as the summer. So this is ongoing. Now, we're getting to this week, and this is an important week, despite the fact that volume in the market will be a bit weaker because desks are closed, but it doesn't mean that the desks are not being manned. And I say that generically. I mean watched. So that's how we say it. Because there's an awful lot at stake here. First, we are going to see whether or not the consumer holds up this week, because this is the most important week historically. And they call it Black Friday because historically that is when U.S. retailers actually turn a profit. That's why it's important. However, over the years, as we all know, we have gone online to buy our Christmas and holiday presents. We go online, and therefore we have what's called Cyber Monday, where billions of dollars are spent. The shift in the consumer is extremely important. And remember, the consumer in the U.S. is 68% of our economy, and that is why this matters. So we will have a sense of whether the consumer is slowing down. Make no mistake about it. The U.S. consumer is looking for promotions. Already, I've been in the stores where promotions are out there, no matter which retail store you go into. And this consumer is also looking for discounts, so promotions, discounts, you name it. And unless there is a product that is a must-have, and we've seen this in the past, that sometimes some of the children's toys are must-have, and folks will line up to buy it at a price that is not going to change because they must have it. That's why they call it a must-have. But absent that, the U.S. consumer is prepared to wait, is prepared to sort of force the retailers to blink before they blink. So we're going to get a picture of how consumer spending is holding up, but that includes this Friday and also Cyber Monday. So what are we doing this weekend? Are we sitting there going and standing in line in stores, or are we online, so to speak, with looking for promotions and bargains online for looking ahead towards Cyber Monday? Very important, because I want to repeat, the consumer is extremely important. Now, the other thing about this week that's important is that we are going to have some economic data. We're going to have today, for example, Monday, November 20th, the U.S. leading economic indicators. That has been negative, and what we want to see if it continues to be negative, or even when you're negative, you look to see, are you looking at a path out of it? So less negative, if you will, less bad news. Always remember, the market looks for less bad news, a turn in a negative trend. And we'll see if we see that with the U.S. leading economic indicators. And then on Tuesday, tomorrow, we'll have existing home sales. Here, too, we know that it has been down, but we're going to see if the trend has eased a bit. And then important is the release of the Federal Reserve minutes coming out at 2 o'clock tomorrow, November 21st. Now, over the years, this has become less important because the Fed's speakers are out there right after the end of the Fed meeting. And they're out there sometimes with a concerted, orchestrated message telegraphed to the market, or sometimes they just speak whatever they want to say with their own respective opinions. I would have to say that listening to the Federal Reserve speakers, the hawks and the doves are actually suggesting, well, market, why don't you hold on a bit? We did not come out and say that rate hikes are over. We're watching everything very carefully, and we have a long time between now and the December 13th Fed meeting. We will be very careful about paying close attention to whether or not all elements, all components within the inflation picture are coming down at a meaningful pace so that we can get to our 2% price stability level over the next year and a half. So this is important. They haven't been coming out and saying, yeah, market, you're right, we're finished. They haven't been declaring victory. They're being very cautious, very careful. The market, however, is saying, oh, you know what? You could say what you want, but you're over. It's done. There's been a dovish pivot, and now we are predicting rate cuts. So again, we want to hear what the minutes say. Is there anything in those minutes that the market has not already captured? And that's where you'll hear more and more folks saying, well, maybe there's something in it that can change or gives us more clarity about the Fed's thinking. So that would be tomorrow. And then again, we're paying very close attention to initial jobless claims, whether or not that shift higher in initial jobless claims eases, and whether or not the continuing claims ease as well. We're going to also have durable goods, and I think this is extremely important because embedded within the durable goods reports is a component for capital expenditures, and that has been coming down. And it's an indication of maybe companies worried that, yes, this debate about soft landing, recession, they want to be more careful because no one knows exactly which is going to hit. So this is something we want to pay attention to, and that will be on Wednesday. We'll also have another consumer sentiment report, and then, of course, we have Friday. And then on Friday, there will be from the S&P Global Services. So this is different than the ISM Institute for Supply Management reports that we pay attention to. They will have a flash report. That means it's not the final report, but what it will be is a report on the services part of the economy, which is the largest, and manufacturing. Again, here too with manufacturing, the United Auto Workers strike affected manufacturing. Of course it did, it across the supply chain. And we want to see whether or not we're starting to see a turn up, even if it's negative, but a turn up as we start to see perhaps a little bit of the unwinding. So it is extremely important for the week, despite the fact that it is a shortened week. In terms of earnings, we are going to hear from Lowe's. Remember, we heard from Home Depot. Now we're going to hear from Lowe's and see what they have to say. And then we're going to hear from John Deere. This is important because, John Deere is a major machinery. They're involved in infrastructure projects. We want to hear what they have to say as well. But we are also going to hear from the last of the Magnificent Seven. That is NVIDIA. They are going to have their earnings coming out in a couple of days. And what we're looking for is whether or not they can beat their estimates. The estimates are actually high. The bar, though, is extremely high, especially in terms of guidance. Remember, the NVIDIA is a semiconductor name, and it has the processors for fast processing, which is needed in the AI revolution or evolution. And we want to hear what they have to say. And also remember that NVIDIA has a issue with China. I won't go into it in this call, but where the U.S. government basically banned some of their chips that were going to China, that NVIDIA itself had created, thinking that they would be able to be compliance approved. So this is going to be important. The analysts are going to be paying close attention to that NVIDIA call and what they have to say about the gap for China. Now, there was a report last week that many Chinese companies were able to buy before the ban quite a bit of the NVIDIA chips. But what we're looking for is ahead. Remember, the market is looking ahead. The market is looking towards guidance. Now, also keep in mind that the 7 big megatech names are responsible in terms of the weight. They're weighting nearly 30% of the S&P 500. So NVIDIA, one of the stars of that pantheon of megatech names, is coming with their earnings report this week. In fact, it'll be tomorrow after the market close. So a lot riding on the market's rally this week, and just to see whether or not, if there's bad news, will the market like it? Because it will convince the market that, hey, just what we're thinking, the Fed is finished and there will be rate cuts. Or if we see a very strong turnout and we can extrapolate that consumer spending is picking up this week, will the market be unhappy about it? Right? Because after all, this would mean that the U.S. consumer is continuing to go out and spend. What do we know? We know this, that the lower wage earner is under pressure. We see it from delinquencies. We see it from late payments. We see it in the subprime auto sector, that the lower wage earner is having problems. However, the U.S. economy is quite broad, and there is a differentiation in spending power amongst the various economic and wage earner cohorts. And for those who have jobs and have received wage hikes, the situation and the scenario is a bit different. Needless to say, as you go up the scale, what you see is the ability to spend more. So again, we're paying attention to the overall consumer profile this week. It's extremely important. Have a very strong Thanksgiving. Have a safe Thanksgiving. And thank you all for tuning in to The Talking Point. We appreciate it tremendously. Thank you.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors or generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.